What is the effective lower bound?
The effective lower bound is the rate below which cutting the policy rate by the central bank does no longer stimulate the economy and aggregate demand. So it's a rate where if you hit it and go below that, cuts in the policy rate will lead to a contraction in the economy rather than expansion. The monetary policy transmission mechanism breaks.
Do central banks have room for maneuver by setting negative rates before reaching that limit?
Policy rates can go into negative territory without hitting the effective lower bound. And this is what we observed in Europe as well as in Japan. Several central banks decided to cut their interest rates into negative territory in order to stimulate their economies and push up on aggregate demand. And indeed, the cutting rates work very well in the same way as they work when you cut rates in positive territory. So that means that at least for the ranges of negative rates that we've seen, the tool is doing its job. We have not yet hit the effective lower bound with the values that we've experimented with.
So, does this most recent experience of central banks in Europe and Japan demonstrate that negative rates are a more effective tool in practice than in theory?
You're totally correct. We've all been taught, sometimes in textbooks, that if you go into negative territory, there's a big discontinuity. Everybody switches to cash at that point, and we haven't seen that. We've seen very little displacement towards cash, and in fact, if you look at corporate deposit accounts, deposit rates there fell to negative territory, and many other interest rates in the economy fell into negative territory, and nothing drastic or dramatic changed. There was no substitution in mass to cash. And one of the reasons is because of safety, storage, and convenience costs. It's very costly to have cash for a company. If you're going to pay your wage bill or buy machinery, using cash is very inconvenient. For households, maybe they can do their weekly shop with cash, but even there it's becoming increasingly hard as we do more digital transactions, and a lot of our shopping is digital. And then there is, of course, a storage cost. It's unsafe to have big amounts of cash in your house or in a company. Maybe in your house you can have under the mattress, the metaphorical mattress, but for a company to hold big amounts of cash can be unsafe, and so they would need to rather pay a small negative rate on their deposit accounts than run that risk. Of course, if rates become so deeply negative that it becomes more attractive to have a security guard and a safe in the company, then of course we will see that type of substitution towards cash, but we haven't yet reached those limits. And indeed what we saw is that negative rates have stimulated the economy with some caveats, because the banking channel of monetary policy transmission hasn't been as strong, but other channels of transmission have worked as usual, as when you cut interest rates in positive territory.
This mechanism can act differently for big, small, open or closed financial or banking sectors. What are those differences?
What we show in our work is that the more access to wholesale finance for companies and banks as well, the more likely negative rates are going to work as they work in positive territory. So the more likely cuts in negative territory are going to mimic their effects in positive territory. So the bigger that wholesale finance sector, the more effective monetary policy will be while cutting into negative sector. Similarly, in open economies, when you have an extra channel for transmission through the exchange rate, negative rates are more likely to stimulate the economy and be more impactful than in a closed economy. So the basic idea is that the more non-banking channels of transmissions there are in an economy, the more impactful negative interest rates will be, because the main friction here is within the banking sector, the fact that deposit rates on household accounts cannot fall below zero or don't tend to fall below zero. Corporate accounts, deposit rates for corporates do fall below zero, but for households not. And this reflects the fact that for households it's perhaps easier or less costly to substitute into cash. And that places a limit on how far deposit rates can fall.
What are the consequences in your analysis of this practical limit on household deposits at zero?
Negative rates have worked in the direction that one would expect. They stimulated the economy and pushed up on aggregate demand when they were implemented in Europe. We saw that most mechanisms of transmission of monetary policy worked normally, except for the banking sector mechanism of transmission. And the reason is that deposit rates are bounded at zero for households. So that meant that for banks, it was not possible to lower lending rates by as much as they would do if they were operating in positive territory. So that generated a friction and meant that the transmission through the banking sector was not complete. It was still positive, but not complete. And that transmission was hence a little bit weaker, but the rest of the channels of monetary policy transmission worked well, and overall negative rates have acted as a standard aggregate demand tool.
Does your model draw a formula to calculate the effective lower bound?
We don't have in our paper. There are many other studies in the literature that have come up with proposals to actually lower the effective lower bound in different ways. We don't engage with that aspect. We take the effective lower bound as given and just investigate what happens when you cut rates in a range that doesn't go as negatively as the effective lower bound. But there are many studies in the literature with proposals to lower the effective lower bound. An extreme one would be to eliminate cash, but there are other proposals out there that could mimic that effect and allow rates to go deeply into negative territory.
Uncertainty is one of the main characteristics of global economic policies nowadays, which could make the euro one of the strongest currencies in the world. What consequences could this have for Europe?
So there are two separate aspects here. One is uncertainty. Uncertainty in general depresses economic activity and pushes down on price pressures. So as a consequence of uncertainty, we might see weaker economies, all else equal. There is a question about uncertainty with the US economy in particular and the dollar and how the dollar will evolve. And in that regard, if there is uncertainty on the value of the dollar or its evolution, that might mean that the euro could represent a good alternative for investors, looking into diversifying into other currencies. So that uncertainty linked to the dollar specifically could make the euro as well as other currencies more attractive, and perhaps then to be the dominance of the dollar as a main reserve currency, global reserve currency. and give more of a role to the euro and a portfolio of other currencies.
In this context of uncertainty, what should be the ECB's monetary priorities?
The ECB should always stick to its mandate, and again, it's doing policy for the euro area. It has a clear target for inflation, and that's the ECB should stick to that role. Given its independence and hence its the record that it establishes as an independent central bank, that will make the euro again more attractive and perhaps increase the positioning of the euro as a potential competitor to the dollar, an alternative to the dollar in international currency markets.